Today, we're going to talk about a topic that most creators wish they'd figured out sooner, which is how to pay yourself from your content business without messing up your taxes, running out of cash, or putting your livelihood at risk. However, a quick note before we begin, this video is intended for content creators who view their content as a business and not just a hobby. While there may be important information here for hobbyists, some of these tips may not apply. So if that's you, I'm going to walk you through 5 common pitfalls I see creators make when paying themselves and how you can avoid them. Before we begin though, here's a quick disclaimer. This video provides general financial education and is not personalized investment, legal, tax, or other advice. Any references to specific securities products or strategies do not constitute a recommendation or endorsement. Please consult a qualified professional for advice tailored to your situation. All right, let's dive in. So the first pitfall that I want to cover is mixing personal and business money. One of the very first mistakes nearly every single creator makes is using a single bank account for everything. Client payments, YouTube AdSense, rent, groceries, gear, upgrades, etc. When tax time comes, then you're left sifting through dozens or hundreds of transactions trying to figure out which expenses were actually business related. This is annoying for one, but problems can go beyond just bookkeeping. If you're operating as an LLC or an S Corp and you commingle your funds, you could actually lose the liability protection that separates your personal assets from your business. That means if someone were to sue you, then your personal savings and assets could be on the line. In this case, the way to solve this is to open a separate business checking account dedicated solely to income and expenses from your content. Every payment from platforms, sponsors, affiliates, or clients go directly into that account. Likewise, every expense gets paid from there. Ideally, you'll also get a business debit or credit card to keep your expenses organized and completely separate from personal spending. It's also prudent to track these expenses so that they're organized prior to tax season, which I'll cover later in this video. Pitfall number 2 is underpaying yourself or not paying yourself at all. A lot of creators fall into the trap of reinvesting everything back into the business. They'll buy new camera gear, better editing software, hire an editor, assistant, or thumbnail creator. And while I'm a huge proponent of those capital investments, there comes a natural time to begin withdrawing from the business. And by properly structuring this, it can reduce your stress and provide some stability to your personal financial situation, which I know many creators desperately wish they had. Ultimately, if you only pull money out sporadically to cover emergencies within your personal finances, you're operating without any kind of financial predictability, which is why it's so important to define some kind of baseline salary or owner's draw, even if it starts small. Paying yourself regularly forces you to think about your content as a real business, and it changes the decisions that you make, often for the better. This also helps you set aside money for your personal life, so rent, groceries, insurance, without pulling from the business account in unpredictable bursts. Over time, you can increase your pay as your revenue grows, but the goal initially is stability. The third discussion point on this list is choosing the wrong payment method. There are 2 primary methods of taking withdrawals from your business. There's a salary, which is more familiar, or what's called an owner's draw. And here's the difference. If your business is a sole proprietorship or an LLC taxed as a pass-through entity, you typically pay yourself with an owner's draw. In these types of structured businesses, your revenue and expenses flow directly to your personal tax return. Then when you file your taxes, this revenue and their expenses are filed on what's called a Schedule C. Under this structure, you literally transfer money from your business account to your personal account. And it's pretty simple, right? But here's the catch. No taxes are automatically withheld from these transfers. You have to make estimated quarterly tax payments yourself. And if you don't do this, then you can end up owing penalties to the IRS, which nobody likes nasty letters from the IRS. On the other hand, if your business is an S Corp or a C Corp, you're required by law to pay yourself a reasonable salary. That means that you have to run payroll, usually through a service like Gusto, and you withhold income, taxes, Social Security, and Medicare just like any other employee. This is a very familiar structure to most. It's how most traditional jobs are. And so once you're designating as a S Corp or a C Corp, then you have to do those things as well. Now, let's say that you have a few months that are going well, and you'd like to draw additional funds from your business, then you can also take what are called distributions, and those are taxed differently. If you get this wrong, like paying yourself only distributions from an S Corp and not having that reasonable salary component, can trigger audits and penalties from the IRS. So the IRS requires owner employees to take a real salary in line with the work that you do. If you're running your entire business yourself, which most creators who are beginning to generate income are, then that might mean paying yourself $40,000, $60,000, $80,000, $100,000 or more as a baseline salary. To figure out exactly what that looks like, I recommend talking with an accountant about your business structure. They'll help you set up the right payment approach so that you're compliant and you're optimizing your taxes. If you don't currently operate under a business structure like an LLC or an S Corp and would like to learn more about which one of those might be best for your channel, I'll leave a link to another video that I made in the description, or maybe I'll put something up here. Now, the fourth pitfall that many creators make is ignoring taxes, bookkeeping, and deductions. Taxes are the number one area where creators get blindsided, because unlike a traditional job, no one is automatically withholding taxes for you. If you're generating revenue from your channel, you are 100% responsible for paying quarterly estimated taxes on that income. If you miss them, then the IRS will add penalties and interest. So if you think about this, at a normal job, you receive a W-2 and you can look at your pay stub and you can see that they withheld taxes. With content creator revenue, the platforms aren't withholding that for you. You have to do that yourself. This is why proper bookkeeping isn't optional. It's literally how you prove your income and expenses. Every single expense, like gear, editing software, internet, parts of your rent, if you have a home office space, should be categorized and saved. If you don't track these carefully, you may be leaving a substantial amount of money in deductions on the table, and nobody likes leaving money on the table. I know that this is a lot, so let's break it down to an example. Let's say that you make $80,000 in revenue and you spend $20,000 a year. You bought some gear, went to a conference, you contracted with a video editor. If you don't properly track and deduct that $20,000 of legitimate business expenses, then you're paying income taxes and self-employment taxes on money that you never really kept. That's why it's critical to set up an accounting system early, even if you're starting small. There are a couple of ways that I recommend approaching this. You could use a spreadsheet to track all of your revenue and expenses manually. This is the free option. Or you could use accounting software like QuickBooks, which allows you to connect your accounts directly so that all of your transactions import automatically and most of the work is done for you. For high income creators or those with many transactions, that alone can save you hours every single month. And it keeps you from scrambling during tax season and makes it easy for your accountant and financial planner to review your financial situation, file your taxes, and help you reduce your overall tax burden. I'll leave a link in the description as well to a simple spreadsheet you can use to get started if you opt for the manual version. Regardless which method that you use though, make sure that you're keeping digital copies of receipts and reconcile your transactions monthly, either in your software or in the spreadsheet. Also, I recommend working with a tax professional who understands creator income. You work in a very interesting, unique environment, and so it's important to try to surround yourself with professionals who understand the nature of your business. If you're working with a good accountant, they'll also help you file your quarterly estimated tax payments, they'll help you maximize your deductions, and they'll even help you plan for your year-end tax bill so that you're not caught off guard. The last thing I'll say on this is to always set aside money for taxes in a separate account. A good rule of thumb is to put aside 30% of your net income as it comes in into a separate account specifically for taxes. Don't touch it for anything else. All right, let's move on to the list. Another pitfall that I often see creators make is not smoothing your income with an income smoothing account. Creator income, as you know, is notoriously inconsistent. One month you get a huge sponsorship and the next month ad revenue tanks and you don't get any sponsorships. This unpredictability is why so many creators find themselves in a cash crunch, which can lead to suboptimal financial decisions. So an income smoothing account acts like a personal payroll buffer. And here's one way to structure your income. For this to work best, you need to know two numbers: your average revenue from the past 6 months and your average monthly business expenses. If you're tracking all of your revenue and expenses using a spreadsheet or accounting software, this will be really easy to find. If you haven't been tracking, then you need to go back and do that step first. Once you have those two numbers, then here are the steps. You funnel every dollar that you generate into your business checking account. Step number 2 is that you create a new account with your bank to use as your income smoothing account. This is the account from which you will pay yourself. And from there, you'll transfer the amount you determine you can draw from the business into your income smoothing account. This amount will be based on the numbers that you calculated earlier. I may go more in depth on how to make these calculations and plan for your income in another video, but I'm going to keep it simple in this one. The result of this is that every month you can pay yourself a consistent amount from that income smoothing account while managing up and down revenue months. And again, I know that that's a lot. So here's the example breakdown. Let's say that your average monthly earnings are $6,000, but it can swing. One month you generate $2,500 and the next month you generate 10 grand. And so based on the average of the last 6 months, you determine that you can safely set a salary at something conservative, maybe $4,500. When you have high income months, a portion of the extra revenue in that high month stays in the income smoothing account to cover the lean months. This way you can avoid that feast or famine cycle and can budget confidently in your personal life and make sure that your business expenses are still taken care of. Now, I said that there were going to be 5 in this video, but here's a quick bonus, and that is to diversify and track your income streams. While this is not technically a pay yourself tip, one of the best ways that you can stabilize your income is to diversify your revenue streams. And I know that you've heard this on many other channels, but I cannot stress enough the importance of it. If you're relying solely on YouTube AdSense or a single sponsor, it's risky. Platforms can change their algorithms, brands can pull marketing budgets, and revenue can dry up overnight. I've seen creators go from making substantial income to almost nothing overnight due to some kind of unforeseen circumstance. And so it may be helpful to track your revenue separately by source and platform. Separate your YouTube AdSense revenue, affiliate sales, sponsorships, digital products, merchandise, any other revenue streams that you have, put them all into a spreadsheet and see which sources are most consistent and profitable. This will help you forecast more accurately and make smart decisions about where you should be focusing your attention. If too much of your income is generated from a single sponsor, it could place your business at risk. The point in all of this is really to build a sustainable business that supports you long-term. Setting up systems and processes along with proper tax and business planning will help you spend less time worrying about money and more time doing what you do best, which is creating. If you found this video useful, I genuinely appreciate likes on the videos. The support has been awesome so far. I really do appreciate it. And consider subscribing for more guides on financial planning and business management, specifically for content creators. With that, have a great week, and I'll see you in the next one. Cheers.